Stocks in particular have a negative impression of being risky investments, which is why many new investors stay away from them. As per the experts, investors typically traverse between extreme ends of emotions. However, investors need to find the middle path between euphoria and panic. So we will discuss some risk management strategies investors should use while investing in stock markets.
First of all, you need to be aware of your risk appetite. Every investor has a different risk-taking ability. One should be very clear about the maximum loss they can bear without losing sleep. And active risk management is a key to limit the downside and to protect profits. Next is to be more active in managing your funds. If you are managing your fund yourself, then it is important to review it at regular intervals. Volatility in the market, changes in the invested companies should be regularly tracked. If you don't have the time, then stick to index funds or ETFs. After this, stick to asset allocation. The last 2 years saw an uptick in retail participation in the equity markets, with many new investors joining the equity bandwagon. Everyone made money when the markets went up. So the entire money went into equities and no one bothered diversifying the portfolio's risk.
Sumit Chanda, founder and CEO of Jarvis Invest, says, if one had adhered to asset allocation aligned to their goals and financial situation, one would have gradually reduced the equity exposure when the markets entered the overbought territory. This would have saved them in the last 6 months when the markets turned extremely volatile. Apply stop loss. Stop loss orders are a tool that investors can use to minimize their losses. This type of order tells your broker to automatically sell a stock when it falls to a certain price, and this prevents you from much loss. For example, if you bought a stock for 100 rupees with a stop loss of 90 rupees, your broker would sell the stock automatically if it fell to 90 rupees. This is beneficial because it can help you avoid significant losses during market corrections.
Besides this, you can keep in mind to invest in consistent dividend-paying stocks. One type of stock that you may want to consider investing in are dividend-paying stocks. Dividend-paying stocks are usually associated with strong and established companies. By investing in dividend-paying stocks, you can receive a constant stream of returns and help to reduce the overall risk in your portfolio.
For new investors, look at staggering your investments in mutual funds. You can invest in equity fund through systematic investment plan. This will help you average out the cost. The power of compounding will ensure you make the maximum out of the investment.
It's often said that stocks are risky due to volatility, and there are ways to manage that risk so that you can still get high returns. As an investor, you need to diversify your investments and not only focus on stocks as an asset class.